Well, the housing market just got a major jolt. Mortgage rates just made their biggest, most dramatic move in years, and honestly, it affects pretty much anyone thinking about buying or selling a home. So, we're going to break down exactly what happened, why it happened, and what it could mean for all of us. So, the big question is, what on earth could cause a shift that big, that fast? I mean, this wasn't some slow, gradual change. This was a sudden shock to the system. Let's find out what pulled the trigger. And the answer, as it turns out, is actually pretty simple. This whole chain reaction was kicked off by one single, huge announcement coming from the Trump administration. All right, so let's unpack this new government program. We're talking about a $200 billion buyout, and yeah, the scale of this thing is just as massive as it sounds. Here it is, the headline number. $200 billion. That's how much the administration announced it would be spending to purchase mortgage-backed securities. And the goal was very specific, to push down mortgage interest rates for you, the consumer. Okay, so you might be wondering, how does buying up all these assets actually make my mortgage rate go down? Well, it all comes down to a pretty basic economic idea. When a huge new buyer suddenly jumps into any market, they create a ton of new demand, which bids the prices up. And for things like bonds, when the price goes up, the interest rate or the yield goes down. It's really just classic supply and demand. So what exactly are they buying? They're buying something called mortgage-backed securities, or MBS for short. Now, the simplest way to think about an MBS is just as a giant bundle of individual home loans that have all been packaged together to be sold to investors. Okay, so here's how that chain reaction works step by step. First, you get a massive new buyer jumping into the market. In this case, Fannie Mae and Freddie Mac. Second, all that new demand for these MBS bundles drives their price way up. And third, for these kinds of investments, a higher price automatically means a lower interest rate. And that lower rate is what eventually gets passed along to home buyers like you. And this wasn't just some theory, okay? The impact on the market was immediate and it was big. Let's take a look at what actually happened on the ground. And boom, here's the result, 6.06%. That was the new average rate for a 30-year mortgage right after the announcement. That's a number the market has not seen in a very, very long time. I mean, the speed of this change was just incredible. On January 8th, the program gets announced. The very next day, rates plummeted by 15 basis points. That is a huge drop for a single day. This new rate wasn't just low. It was the lowest level we've seen in almost 3 years. The market reacted, and it reacted fast. So what does this mean for the spring home buying season, which is usually the busiest time of the year? Well, things are definitely volatile, and there are still a lot of questions. But, for qualified buyers who've been kind of sitting on the sidelines waiting for a sign, seeing rates drop this fast could be the exact push they need to finally jump in. This could seriously energize the whole season. But, and this is a big but, this whole rate drop isn't happening in a vacuum. Lower rates are a huge deal, for sure, but they aren't the only thing shaping the housing market right now. We've got to look at the bigger economic picture. And that brings us to a much more sobering number. 56,000. That's the net number of jobs that were lost in the U.S. during the last quarter of 2025. So why do we care so much about the job market? Well, it's pretty simple, right? You can't buy a house if you don't have a job. This slowdown in job growth really helps explain why home sales were kind of a disappointment at the end of last year, even though rates were already starting to come down. It's a really powerful force pushing against the market. Now, at the same time, let's talk about inventory, the number of homes actually for sale. Take a look at this. At the end of 2025, we had about 1 million homes on the market, which is almost exactly where we were back in 2019, before the pandemic. So this tells us the market isn't starved for supply anymore. It's actually getting back into balance. So what you've got here is this incredible tug of war happening in the 2026 housing market. On one side, you have the massive positive pull of these new lower mortgage rates trying to get people to buy. But on the other side, you have this cautionary pull of a slowing job market, which means fewer people can actually afford to buy. It's like these two giant forces are pulling the market in opposite directions. So when you put all these pieces together, what's the big picture? What's the forecast looking like? First, let's just remember where we were coming from. The year 2025 was all about cooling and normalization. It wasn't a crash or a fire sale, not at all. It was a steady move away from the craziness of the past few years and back towards something a bit more sustainable. Right, so this kind of shows the path we were on. The idea was that 2025 was all about cooling things down, and the forecast for 2026 was for things to finally settle into a healthy, balanced state. The trend, before this big announcement, was a gradual return to normal. Which brings us to our final, provocative question. With this massive new government intervention suddenly pushing rates down so hard, is the year of normalization over before it even got started? Will the stimulus reignite a market frenzy? Or will that slowing job market keep things in check? Well, that is the $200 billion question for 2026.